What is going on, everyone? I hope you are all doing well. Welcome to episode 3 of the free course. Today, we're going to be talking about 20-day alignment, meaning you want to try align yourself with the 20-day IPTA data lookback. And if you don't know what it is, we'll be diving into what it exactly is. But first, I just want to explain a bit about how it works and how we actually use it to our advantage. Now, the 20-day lookback is the day before you're trading. Go back 20 days, count back 20 daily candles, and that is your premium and discount, the highest high and the lowest low. They are also your key premium and discount arrays. Now, this is the absolute key to daily and weekly buyers as well. This is what people don't teach. This is key to daily and weekly buyers. Why is that? Well, it's because the PD arrays that we see in this 20-day look back are key for us to use our if this, then that approach. So you guys know I approach buyers through a lens of if we do this, then we should do that as well. Since I approach it through that lens, the key PD arrays I'm really looking at are the ones in the last 20 days and how we react to those ones in the last 20 days. So let's not waste any time. Let's get into some charting. So let's go to the daily time frame. And you want to think about the last 20 days. So count back 20 bars. I like to hold shift and then just drag it across 20 bars. And then the highest high and the lowest low is your premium and your discount. So in this price leg, this is your discount, this is your premium. How we react. Now go back, 10 seconds or so. I said how we react to these price levels in the 20-day look back is how I determine bias. What do I mean? Well, perfect examples are here. These are always examples. Now, first of all, what are PD arrays? And this is going to be one of the best episodes in the course. What are PD arrays? FEGs, order blocks, old lows and old highs, which means swing highs, swing lows, and any old lows and highs, because it's important. It's all important because it's all in the last 20 days. Inverse FEGs, breaker blocks, whatever it might be, right? You get the point. You get the gist of it. Now, what you need to understand is how we react to each of these in the last 20 days is pretty much how I determine a bias and what I'm looking for. Now, partner that up with weekly profiles and you have a recipe for success. Now, so let's look at this. You want to pretty much identify all the premium and discount levels. Don't label them all because it will get confusing, but identify them in your head. Point them out to yourself. So, for example, this down close candle before this move higher, I would say it's bullish order block. And obviously, it's in our last 20-day range. This, for clarity, is the last 20 days, right? So this is the last 20 trading days. That is a key level. That is a level we could see rejection from. That is a level that could be used for a target. All of those things. This is a bearish order block, right? This in the last 20 days in a premium, because again, discount premium, that's a bearish order block. That's also a level we could use as a target or as a rejection from. Excuse me. This fair value gap in the last 20 days in a premium, that's a level we could use as a target. This old low, previous day low here, that is a key level. This low here, this swing low right there, that is a key level because it's an old swing low inside of a discount of the last 20 trading days. And then one more example, this volume imbalance here. This one. Okay? Now, what have I just labeled? Let's recap. This low, this order block here, this order block here, and this volume imbalance. So 2 discount arrays, 2 premium arrays. You only want to focus on the discount and premium arrays in the last 20 days. And people think I'm joking when I say that. I'm absolutely not. You only want to focus on those. Why? Because it blocks out the noise. The algorithm is only referring to these levels. It is not yet referring to lows down here. If we break out of the range and as we drag the 20 days across, these start to become important, whatever. But right now it's working within this dealing range, and it is only focused on this dealing range because it's in the last 20 days. Um, these gaps here, this gap, for example, important because it's in the last 20 trading days. Where could we aim for? This order block, this volume imbalance. Do you see how I'm bringing in each array and how each one has its own value? I'm assigning its value, its importance. Now, this is the PD array matrix, and this is how you actually determine bias. You determine bias through this because the algorithm is only focused on the last 20 trading days. This is what people don't tell you. My eyes are straining, so let me put my glasses on really quick. This is what people don't tell you. Okay, people don't understand that the algorithm's only referring to the last 20 trading days. Now, you want to be doing the same because this is how you determine bias. Guys, stop looking back here. And why did I tell you you only want to be able to predict the next daily candle or the next weekly candle? But we're not focused back here. We don't need any of this. None of this is relevant for us to predict the next candle. Why would we need to look down here? We're focused in the last 20 trading days. So for example, today, I am bearish on NASDAQ. Do I think it's going to get down here? No, I'm not saying that. Not in one day. I'm bearish NASDAQ. Why? Well, because we're in a premium. This is a premium. Simple, right? Last 20 trading days, premium market. This is, as I mentioned to you guys, an order block. So we've come into this order block. Mean threshold eyeballing it is about there. We've hit that yesterday. Now take a look at our week. Monday, Tuesday, Wednesday, Thursday. What happens on an expansion week? Usually we trade back into the range on Friday. Thursday caps the weekly range. So isn't it reasonable for me to say, okay, we've hit a premium level in the last 20 days. Mean threshold of this order block. Mean threshold, for those of you, just 50%. So take the body, measure out 50%. It's about there. I'm eyeballing it, but it is about there. I've done it enough times. I can eyeball them. Thursday caps the weekly range. Friday's likely to trade back into it. Now, unfortunately, it has already made a massive move down during London, which I did miss because I focus on New York session. I do think we could get down here in New York irregardless. But I'm simply showing you guys how I'm building a story behind PD arrays. I'm building a story behind every key array that appears at a key time, not random ones. The last 20 days. This is what everyone gets wrong. Everyone on YouTube with YouTube level education is looking down here, trying to predict the next candles, the next 20 candles. Guys, forget the next 20 candles. And this is why I'm making this free course, because it's going to absolutely evolve your trading to a different level. This is a different level of education that people do not teach. Forget this. Guys, forget it. When we break out of this range, then we can worry about that. Or, like, for example, if we come down here, let me visualize everything, because a lot goes in my head that I can't really, that I just assume you guys know and understand, and I really need to realize I need to explain absolutely everything. If we break out of this range, then I can begin worrying about what's down here. Like, then I can look for that. But until we do that, I'm working within the last 20 trading bars. Okay, trading days, not days. Not Monday, Tuesday, Thursday, Friday, Saturday, Sunday. No, the last 20 trading days. Okay, you literally press shift and count back the day before you want to be trading. So today's Friday, right? This is Friday's candle. The day before Friday, Thursday, count back 20 days from that point. As soon as you see 20 bars here, the highest high and the lowest low, take that range. That's your dealing range. And then you have key arrays in that range, right? This is like a different level of education. I want to drive it home because this is all you need. Stop listening to people on how to determine bias and they just say it's swing lows. Guys, please forget that. It's the reason swing highs and swing lows work on predicting the next candle is because of the 20-day the data ranges. The PD arrays in here, how we react to them tells you exactly what the next candle or the next candle after that is going to do. Because, for example, if Friday closes like this, I'm expecting Monday to look down here and trade into these lows. Why? Because we've come up into a premium, hit a premium key level, rejected from it, and now we have a swing high created. I don't want to see that swing high broken. Why? Because it also filled a daily fair value gap. And the one-to-one students will know what I'm talking about. That I classify that as a certain high that I don't want to give away here, but I classify it as a certain high. And that's all I'll say for now. But yeah, 20-day look back. And guys, this works for dollar. This works for absolutely everything. Now, I'm not sure if I mentioned this, but dollar is terrible right now. Don't even bother. There's absolutely nothing going on in this market. You don't want to trade this. I know everyone on financial Twitter seems to be trading FX and winning. That's what you'll see often. It's all noise. It's all nonsense. They don't know what they're talking about. They're risking in conditions that just are not optimal at all. So, yeah. Now, just to end, guys, the last 20 trading days are all you need for bias. The reason I say I'm only trying to predict the next daily or really the next candle, right, is because I don't need to be worried about what price is going to do 5 candles in the future. That's not relevant to me. And I'm only focused on what the very next candle will do. And that's all you need to be focused on. That's why I say you only need the last 20 trading days. The last 20 trading days are more than enough for you to gather information and determine what the next candle is going to do. It's the whole reason I say it's the only thing you need. It really is the only thing you need. You don't need anything else. The last 20 trading days gives you absolutely everything you need to determine daily bias. And I see so many people mess up by being worried about the next 5 candles or the next 20 candles, whatever it might be. I see so many people mess up in that aspect when you don't need to. All you need is the last 20 trading days, all right? 20 trading days, not days. Use that information, use the arrays in that area. And I think, let me see, because on my Notion, I used to watch ICT 2021 mentorship, and I think it's some of the best information out there. I remember a specific episode he did on this, and again, no one's put in the same amount of effort that I put into this. So I particularly remember an episode where he spoke about the 20-day trading range, and he broke it down perfectly to say exactly what we need to do, right? Let me see if I can. Yeah, perfect. So he put, we have moved up into an optimal trade entry between the high and the low here. Go back and think about the 4 functions of price delivery: consolidation, expansion, retracement, reversal. And then he goes into how we're missing certain parts of that function. And we'll dive into that a bit more. But on his chart, he's only referring to the PD arrays in the last 20 days. Because that's all that's important. Nothing else is relevant to what he is trying to predict. Nothing else relevant. You don't need to worry about anything else. You're just thinking about the last 20 trading days because it provides you all the arrays the algorithm is referring to. Absolutely all of them. So you don't need to worry about anything else. And with that being said, I'll end the video here. I hope you did enjoy episode 3, and I'll catch you guys in the next module.